promise you I am the warm-up act for today. Our two main event presenters, Carmen and Michelle, follow. And just to kick off with a little bit of tax before we get into the exciting part, which of course is the financial reporting, I wanted to talk to you a little bit about reportable tax positions. I was thinking about this on the weekend. What is it exactly that would give tax directors nightmares? And I suppose when I was thinking about what kind of nightmares there are, I'm not thinking about the kind of nightmares that tax directors in-house have in a personal sense. It's not, backing over the family dog in the SUV with all the children watching or anything like that, but what kind of professional nightmares would be involved? What would be a tax director's worst nightmare? And there's some aspects of this reportable tax position, which, to be honest, what would they look like? Well, they might look a little bit like what aspects of our business and the way it deals with transactions, the positions it takes on tax and how to deal with particular transactions that are, I suppose, subjective or in some cases are based on a precedent where there's no, it's about as likely to be incorrect as correct. And that kind of disclosure, especially if I was a tax director and I had to do it in front of the tax office in a tax return, that would make me really nervous. Well, what in particular, so what have we got with the reportable tax position? That's exactly where we're going. So the reportable tax position and what it means for your business, I'll run through in a little bit more detail. In essence, it requires us to think about the way in which, for a particular entity or particular financial statements, what aspects of the way transactions are dealt with are about as likely to be correct as incorrect, or in some cases you can actually have to report on a reportable tax position that you've taken where it's more likely that you're incorrect than correct. So these are the aspects of, I suppose, a large entity dealing with transactions that make it the tax function most nervous, and we're now in a position where whatever those positions are effectively have to potentially come out through tax return disclosures annually. Now, the RTP, if you do it, is now scheduled to the tax return, and so it incorporates three particular aspects. I won't go through too much detail what they are, but I can summarise it. It's that the Part A, or Section A, the reportable tax position, asks you to disclose any material and certain positions that affect your tax return disclosures. Part B asks you to disclose any material tax uncertainties which relate to financial statements representation of tax. So it's not just what goes in the tax return, it's also what it is that you disclose through your financial statements. Now, when I was talking to Michelle and Carmen a little bit earlier, they also said, also be aware that this also has a financial reporting aspect. They mentioned FIN 23, not something I'm familiar with, but it is very much related to considering and adequately disclosing what kind of tax uncertainties you have through your financial statements. And that's where you'll see an intersection between Part B of the reportable tax position and what you have to do through your financial reporting function. Finally, in Part C, and I'll go into a little bit of a flavour for what's in Part C, is I suppose I could describe it as 24 questions which have a grab bag of questions around whether or not you've engaged in any particular types of transactions the tax office has got on its radar. In particular, so it's got a series of taxpayer alerts, and to actually understand and answer each of the questions in Part C, it's extraordinarily difficult because it sort of requires the in-house tax function to have a knowledge of these 24 different particular types of transactions the tax office is looking at, to be aware of that and also to understand that that requires a disclosure on a tax return. It's written in quite impenetrable language, and I'll give a couple of examples when I get to that point. So the reportable tax position has actually been around for quite a while now. I think it's been around for 7 years. But you had to be really special to get an invitation to lodge an RTP in years ending before 30 June 2019. It was sort of like that club that you can never quite get into, even if you actually did, which I can't really think of a great reason to. But for years that end 30 June 2019 and later, effectively taxpayers are required to self-assess, are you in or are you out of the requirement to lodge a reportable tax position with your annual tax return. So we are in a situation now where 30 Junes, if they're affected, should be in a position to lodge this. And also for 31 Decembers, for the coming year, you'll need to have enough information available so that you're ready to disclose both for financial reporting and also on your tax return any material uncertain tax positions. So who's in and who's out? Well, first of all, it's not all domestic taxpayers. You have to be either a public entity, and what that means in essence is that your top 20 shareholders have to have less than 75% of total ownership. If you're closely held, you should be out of it. Also, if you're domestically owned, you should be out of this regime. But if you are what I call up there, either a public or a foreign-owned group, if either your Australian tax disclosed income is $250 million, or alternatively, if you're part of a group of entities that discloses $250 million or more of income on all of the aggregate Australian tax returns, then you're into the reportable tax position, and you do have an obligation to file this probably with your next tax return. Now, I suppose what's interesting to me about the different aspects here is that over time, especially multinationals have been subject to a mushrooming array of different taxation compliance obligations, starting with the IDS, which has been around now for about 8 years, International Dealing Schedule, which was, I suppose, much longer than the tax return itself, country-by-country reporting. Coupled up with that is the fact that the significant global entities that had to do all this reporting suddenly started to face penalties 100 times every other taxpayer, $100,000 per 28 days. So it is quite different in the sense that it's, I suppose, focused just on your Australian operations. It's not so much dealing with transfer pricing, like transfer pricing is something you would look at. It's very much based on, are your Australian operations significant enough to meet the $250 million of domestic turnover test? And if you are, that you're potentially in the RTP. So a lot of significant global entities will also have this reportable tax position requirement. Some significant global entities will have relatively small Australian operations, that is, they don't have $250 million of Australian turnover, and so they'll be out. And there'll also be some domestically based enterprises which don't have material international dealings, but they'll suddenly be in reportable tax positions. It's quite different. Now, just a concept with grouping here. The grouping is probably a little bit different from how I would consider it for example, defining whether or not you've got a significant global entity, and often that will come down to a definition of control and whether or not you are consolidating into the ultimate parent entity financial statements, your ownership. So an underlying ownership of 50% or more will cause you to have a grouping situation, and that can be even though someone else actually exercises control over those entities. I suppose what's useful to understand a little bit better is uncertainty. When we say a position is certain in terms of tax law, what's meant by that? Well, this comes down to, I suppose, looking at authorities, and authorities within the context of the reportable tax position is very narrowly defined. It really only relates to public rulings, cases and legislation. Whereas in a lot of situations, what I find is that taxpayers will take guidance from a range of different potential avenues to try and get to the right tax position on a particular transaction, a series of transactions. So things that aren't authorities for these purposes will be the lesser forms of assurance statements that the tax office releases, and they do this much more habitually now. They release the compliance guides and practice statements and interpretive decisions and private rulings and so on and so forth, none of which are actually authorities for these purposes. And another thing is often that, unfortunately, taxpayers are getting very used to legislation by press release. That is, we don't actually see the final form of legislation for a significant period after the anticipated start date of that new legislation. So often taxpayers actually have to take a position on something that's unenacted. That doesn't actually form a basis or an authority for the purposes of all this, and nor does things such as tax office administrative practice or even industry practice. So that's a really important thing, because I suppose to me it really does widen out the scope of positions that you can take that are supported by something, but it's not a public ruling, legislation, or some kind of piece of case law. Now that's all a little bit frightening, and I suppose what you're seeing there is just, well, suddenly I thought that there's a vast array of things and transactions that I took positions on in my financial statements and my tax return. which had authority for them. Oh, well, actually, yeah, there's a great deal less in terms of authority for the purposes of the RTP than you would have imagined. So one thing that can be extremely useful for a lot of taxpayers is that there's this concept of materiality. And just to make it more complicated for finance functions in this case, the materiality has nothing to do with your financial statement's definition of materiality. So it's quite a different approach. So something can be material for these purposes and not financial statements or the universe as well. So a simple version of it, I would say, is materiality is basically defined by its relativity to your income tax expense for that particular year. Short version of it is, if a particular transaction or position has an impact of less than $3 million on income tax expense, it's not material. And look, that can take some comfort from that, because I suppose what we're looking at is something material means, generally speaking, a revenue or expense impact of $10 million or more if you've got a 30% tax rate, and you will if you're one of those category of 250 million plus taxpayers. If it's more than a $30 million income tax expense impact, it will always be material. You'll definitely have to disclose that. And if it's in between those two, as in its impact on your income tax expense for that year is between $3 million and $30 million, then it will depend on whether or not it is more than 5% of your income tax expense for that year. Now that materiality concept applies for Section A, which is about income tax which you disclose in terms of uncertain positions on your tax return. Section B, which relates to uncertainties which relate to financial statements, presentation of taxes. So that can be around how you've decided to present deferred tax assets and liabilities on your balance sheet. Section C looks at something which is quite different. It has that range of 24 questions. And I've just given a little bit of an example there of some of the language that tax functions and advisors are required to deal with and understand. Have you entered into any arrangements which are a variation of taxpayer alert TA 2015-5? I've got a little confession to make here. I spend my entire professional life looking at tax for corporates. I very rarely spend any time staring at that particular taxpayer alert. I would have to go in there and read it and understand exactly what it is. And also, to identify that type of transaction in somebody who I was advising, I'd actually have to have an understanding and appreciation of the transaction that undertaken for the year. Not only that one, but the other 22 questions that we get up with in Section C. So what I see is this will be a particularly difficult one for advisors to have visibility over, and it's a particularly dense and tricky one for tax and finance functions in-house to be able to identify and understand, oh, hang on a second, I'm about to do a transaction, or I have done a transaction which is within the tax office's sites under a taxpayer alert. Some of them are around international related party dealings, but there's a range of different things there. There's hubs, there's thin cap revaluations. You can see the second one that they've asked there, have you got related party dealings involving inbound distribution arrangement? Probably, maybe. Disclose the zone you have self-assessed in accordance with the draft compliance guidelines. Gee, 24 of these questions. Now, in a lot of cases, taxpayers will hopefully not be affected by any of the taxpayer alerts, but you have to understand what the taxpayer alerts are as to whether or not you've undertaken any of these transactions. One that I have seen, which is particularly important at the moment, is for those groups that have international related party finance. A lot of you will have seen there was a practice, a PCG released in relation to effectively allowing taxpayers to self-assess what risk zone they were in relation to the way that they set up their international related party financing arrangements. And why that was really great was it allowed certain taxpayers to, I suppose, not have to go through a full transfer pricing study to understand where and what extent of risks they actually bear with their related party finance arrangements in a relatively straightforward way. And so it gives you a colour coding. You can either have white, which is the tax officer's examined you, green and blue, you're in the right kind of place, yellow, orange, red. But if you haven't already undertaken that exercise, which I do recommend that you do, because it is, to my mind, a really cost-effective way of managing transfer pricing risk around intragroup finance, it actually explicitly now asks you in Section C of the practice statement in relation to your international related party finance arrangements, what colour code have you self-assessed? So you have to get in there and work through your loan agreements and work out what colour code you want to disclose to the tax office. So if you haven't already done that, it's probably a pretty good idea to anticipate the disclosure of that in the next tax return if you're affected. So, what are the takeaways, I suppose, from my part of the presentation today? First of all, just decide and work out whether or not you're going to be in a position where you're going to have a reportable tax position in the future. It's not by invitation anymore. You have to be aware and self-assess whether or not you're obliged to lodge one. And have an awareness at the same time in terms of your financial statements preparation and audit function of potential impacts in the same area of disclosing tax uncertainties through FIN 23. So that's something that I think really has to come forwards to the process of financial statements preparation. It can't really be back-ended to tax return preparation, and if you're not prepared for it at the time that the tax return is being done, you can expect the level of resource investment that's required either in-house or through an external advisor to be quite resource hungry. So it's one of those things where an ounce of planning is much better than a ton of cure. And the last one I suppose I would say is have a good critical thought and evaluation of what are the key and material tax risks in your business. Because if you haven't already undertaken that activity, well, first of all, understanding what key tax risks are is probably central to risk management. But in any case, the fact that you'll have to disclose all of these things to the tax office in a way which brings a lot of tax directors, the kind of things I was talking about earlier, that is something that's coming to you very soon.
I'm going to be chatting to you about leases today. Something perhaps a little less or a little more light-hearted than what Joel's just taken us through. I'm glad that's got nothing to do with me. So let's get straight into it. And then I will pass to Carmen, who will get you up to speed with what's happening in special purpose financial statements. So, as I'm sure you're all aware, under the requirements of the new leases standard, AASB 16, most leases are now going to be brought on balance sheet in the form of a right of use asset with a corresponding lease liability. I say most leases because there are two exceptions, which I'm going to chat about a little bit later. Now, this represents quite a change from what was previously done for operating leases under AASB 117. Previously, operating leases were recognised on a straight line expense, as an expense on a straight line basis over the term of the lease. This accounting shake-up has made AASB 16 quite popular in the media. These are some of the headlines in which AASB 16 has featured over the last couple of years in the build-up to the effective date, which was 1 January this year, in case you missed it. At the time of issuing IFRS 16 is the international equivalent for AASB 16, the International Accounting Standards Board made an estimate at the time that said about half of all about half of quoted companies globally, there we go, would be affected by the new leases standard, pushing about just shy of $3 trillion worth of leasing obligations onto their balance sheets. The point I'm trying to make is that while your organisation might not be a Myer, might not be a Woolworths, I'm sure it engages in some level of leasing activities, meaning you will be impacted by this new standard. It cuts across all sectors, all industries. And just in case you weren't aware, I've already mentioned the effective date. This standard became effective 1 January 2019. Any December year-ends in the room? You've got 2 more months left till the end of your first year under this new standard. June year-ends, well, you've got an additional 6 months. Little extra time, but still 8 months for a standard like this is not that much time. And certainly, while AASB 16, personally, I don't think it's as challenging as AASB 9 and 15, which we've all just navigated our way through. I would encourage you, if you have not yet turned your mind to AASB 16, now is the time to do so. There are still a number of decisions, judgments, and calculations that have to be made in applying this new standard. So I guess time to get cracking on your implementation project if you have not already started. And of course, the challenge just becomes harder the more leases you have. If you've got just a couple of leases, perhaps it's not such a big deal, but certainly something to think about, and especially since hopefully AASB 9 and 15 are done and dusted and taken care of. What we'll cover today, we're going to look at the definition of a lease, because this is quite a change. This is the new test that determines whether or not an arrangement comes on balance sheet. Previously, it was differentiating between an operating lease and a finance lease. It's now about applying this new definition. We're going to look at lease payments. Which lease payments do you include or exclude in working out your lease liability? The standard is very clear on what you include and exclude. We'll take a look at that. Lease term. How long is my lease term? What is the enforceable period? We'll look at particularly how to deal with options to renew or terminate. The discount rate. I anticipate that's going to be the aspect of the standard that is going to pose quite a challenge for our clients. I'll take you through that and you will see why I say that. It's going to be a massive judgment area. And then we're going to end off on looking at your options in terms of transitioning to the new standard. There are 3 options, and we'll also look at the practical expedients that are available to you in making your calculations easier when transitioning to the new standard. So that's what I'm going to cover today. So let's get into it. What is a lease? This is the test, as I said, that determines whether or not a lease is on or off balance sheet. So it's critical to get this assessment right. As defined in the standard, it is a contract or part of a contract that conveys the right to control the use of an asset or the underlying asset for a period of time in exchange for considerations. I'm not going to spend a lot of time on this assessment today. Reason being, I think most of the time you would have the exclusive use of an asset. You wouldn't really be sharing an asset. However, if this does apply to you, I will just draw your attention to the fact that substantially all, what is substantially all? It is not defined in the standard. It's going to be a judgment area. You will have to make an interpretation for your organization, draft an accounting policy, and apply it consistently to all your leases. That's the only thing I would like to say on that particular assessment. Moving on, if you say yes, I'm using the asset exclusively. Move on. Does the customer have the right to direct the use of the asset throughout the period of use? And this is all about who controls the use of that identified asset. If the customer can change how the asset is used throughout the period of use, or the customer can change the purpose for which the asset is used throughout the period of use, then you're probably in a lease. If the supplier, on the other hand, can make the how and for what purpose decisions, it's probably a typical supply arrangement. And that would be recognized in P&L as an expense. You wouldn't have a lease in that case. Okay, so who controls the use of the asset? If it's the supplier, if it's the customer, you probably have a lease in that case. Any questions? Please stop me as I progress. You're welcome to, yes.
If you sublease out a section of the factory to an outside body, does that reduce your footprint on the financial statement?
In terms of
lease for the total amount, then you sublease out all the factory.
Yeah, you'd probably have to Carmen, correct me if I'm wrong.
So for a sublease where you're the lessor, you still have to make the operating finance lease decision. Is So you would have to decide whether to operate on a finance lease, depending on what you decide, depends on what asset you end up with. You probably still have your liability, because the head lease will probably say, don't care if you sublease, you've got responsibility.
Just a question here. Coming back to the first example, you gave us the car park space. So in that example, you said that if not everybody's not parking there in their own spaces, so it's out of that lease. And coming back to the third condition here, the user had a right to use that car space, but the right is still with the user. So is it not coming back into the lease again?
So you're saying there's this, even though they're not parking on the same spot, are we not back to this?
Yes, they still had a right to, like they can say to their employees that you can park to a specific car park.
You're in the car park, but you've only got the use of 45 spaces within that car park. So the fact that we haven't even passed this one, it's no, we don't have an identified asset. We don't even progress to step 3. That's how I would have done it. Those particular spaces are not identified, correct?
They can sublease that out of like 45, they can sublease that to somebody else, so they still had a right here to use that car space.
I'm not sure now that you mentioned. The fact that we didn't even have an identified asset, I didn't get to step 3. So I wouldn't even consider this because I'm not using.
But there is an identified asset because a right is an identified asset. A right to use an asset is still an asset.
So if you think in Michelle's example, and I'm going to put words into your mouth, you've got a car park that has 500 spaces and you've received 45 passes to get into that parking spot. If there's only 43 spaces left when someone comes in, tough, there's no spots for you. As opposed to there are 45 dedicated car parking spots that are for ABC company in that car park. So that's the differential in Michelle's example. If there was 45 dedicated car parking spots, regardless of the fact David's in there today, I'm in that spot tomorrow, that's different. So if that helps.
So you're not saying there's 45 spots for a company and your employees can get them on a first come, first served basis. You're saying there's 45 spaces, the whole car park and your company can use some of them. That wasn't quite clear.
Oh, sorry. Yeah, my bad. As opposed to 45 dedicated spots where the cars would be on the same spot every day.
Well, no, surely if you've got, because we have this situation where we have some dedicated to some people and some which are open to other people. But we have 4 spots. Yeah. Our company has 4 spots. They're identified in our lease. They're 4 assets. Sure, they're all part of the lease.
Correct. And are they the same spots every day?
Yeah, they are.
Correct. So they
can use them. It doesn't matter.
Oh, that doesn't matter.
Yeah.
That doesn't matter. But they're the same spot.
Yes.
It's the same spot, dedicated spot every day that you can utilize. Who's using that doesn't matter.
Cool. Thanks.
Yeah.
So if there is, they have a termination clause, let's say for 3 months.
Sorry, can't quite hear.
If there's a termination clause in the lease, say 3 months or 6 months, so the lease term is 5 years or 10 years. So we need to reconcile it in the balance sheet.
Can I pause? Can we park that for now? Pardon the pun. Because that will cross that bridge when we talk about lease term. Is that okay? And if I don't answer your question, you can just raise it again.
All right.
Okay. All right. So from just a practical consideration from your organization's perspective is how are you going to go about identifying all your leases? I'm not sure going to the manual file with all the paper documents is appropriate. Because this definition of a lease is casting a wider net, you're going to have to think, I think, more broadly. The general ledger is a good place to start. Go and identify payments, recurring payments, where there's a specified asset involved. That's where I would start. Do a walkabout. Identify those assets that you don't own outright. Could be water coolers. Now, yes, they might be, you might get them out because they're short-term or low value, but cross that, first identify them and then scope them out. I believe in the public sector, tender registers and contract registers are quite common. So that could be a place to start to identify potential leases that will be captured by this new definition. Okay. Just something I want to mention, substantive rights to substitute the assets. This links back to assessment 1, whether or not you have an identified asset. So even if the asset is specified, if there's a clause in the agreement that says the supplier has the right to substitute the asset throughout the period of use, well, then there isn't an identified asset that is being controlled by the customer. Then there is no lease, and you're outside of AASB 16. So for those substitution rights to be substantive, the supplier must have a practical ability to substitute those assets. So if the customer can't prevent the supplier from substituting the assets, and also, replacement assets must be readily available to the supplier. Also, the supplier must benefit economically from doing this. So benefits of substituting the assets must exceed the costs of doing that. So going back to that example where we had a number, I think 20 workstations in a specified area in a shared work environment, if there was a clause in the agreement where the lessor could just move those 20 stations to another floor or across the room to another corner, and the lessee couldn't stop the lessor from doing that, you would probably have a substantive right of substitution. There would be no lease to bring on balance sheet because there's no identified asset. In that case, I'm guessing the costs of doing that would be minimal for the supplier, for the lessor. So we probably would benefit economically from doing that anyway. So just watch out for these. Some of you might be thinking, but how as lessee do I know if a supplier's right of substitution is substantive? Because this is from the perspective of the supplier. The standard says if it's unclear whether or not those rights are substantive, you don't need to go and expend undue cost and effort in this regard. You presume the right is substantive and you bring it on balance sheet. Might be worth the effort to go and talk to the lessor. Okay. Oh, and when is this assessment made? It's made at the time of signing the contract. Future events that are unlikely to happen are ignored. So just a clause to watch. It's not something I've seen yet. I haven't seen much in terms of AASB 16, I must be honest. I think people haven't really thought much about it to date. But just something to watch out for in your lease agreements that might get you out of lease accounting. So once you've identified that your arrangement is a lease, the next thing to consider is lease term. This lease term starts when the lessor makes the underlying asset available to the lessee. It's commencement date. Now, commencement date is pretty important. It's from this date, it's on this date that the right of use assets and the lease liability are calculated and recognized. And it's from this date that interest and depreciation are calculated. Take note that rent-free periods and rent-reduced periods, you include those in working out your lease term as well. And how do you work it out? Well, it's your non-cancelable period of your lease, plus any periods under options to extend, if you as the lessee are reasonably certain you're going to exercise those options, plus any periods after optional termination options, if you are reasonably certain that you are not going to exercise those options. So this is pretty, the non-cancelable period of the lease is pretty straightforward. That is generally as stated in your lease. This is going to be judgmental because what is reasonably certain? again, it's not defined in the standard. You will have to apply judgment. And this judgment gets harder to apply the further out into the future that these options are. So I'm probably going to mention this a couple of times during the session today, but I encourage you to document your considerations in judgment areas. For example, options to renew and extend and terminate. Document your considerations, not only for your auditors when they come asking questions, but also to remind yourself of what your considerations were 5, 10 years down the line.
Does it matter if you stay in the building or if you actually exercise the option? As in, we never exercise options ever.
Yep.
We always renegotiate a new lease, but we stayed in the same tenancy for some periods because it's never commercially sensible to just exercise the option. We always go back and renegotiate. We never exercise options.
And so you're renegotiating a lease basically from scratch.
Effectively, yeah. With all
And that's what your past actions have indicated. I would say in that case you're not reasonably certain to exercise your option. Oh, I see Carmen's looking at me. Because they've never exercised the option, they're renegotiating a lease.
So my view is that it is a modification of an existing lease, and that is in the definition of a modification, that it's a renegotiation of the terms. So you are exercising it, it's just that you are renegotiating the terms and having a separate piece of paper. To me, having a separate piece of paper doesn't mean that you can start again from scratch. In substance, you are starting the new lease from the second the old lease finishes. Sorry?
We're not setting an obligation because it is a new lease. It's always a new lease.
Yep, but your intention is still to stay. You are just going to renegotiate to get better terms.
No, our intention is we will never exercise an option. We have to have the option. We just never exercise.
But effectively, you are exercising them, just renegotiating different terms. So and this is where Michelle was saying it's a judgment call. To me, if the new lease starts the second the old lease finishes, I'd struggle.
Yeah, fair enough.
Yes.
Sorry, what if it's the same lease but a different vessel? I mean, same asset but a different vessel.
So, same asset, different lessor
Yes.
that have a new contract.
So we're subleasing at the moment, and then our sublease ends, and then we'll be leasing directly with the lessor, the head lessor. So in that, is that an extension of an option? Is that just renegotiating the terms of the lease?
No, I would think there you exercising an option to extend. Yeah, the substance, yeah, correct. The substance I would think is the same thing as exercising an option to renew or extend,
Okay.
even though the lessor is different. Same asset. Yeah. This is going to be a judgment area. There are a lot of judgment areas in AASB 16. You know, when you read the standard, it seems quite straightforward, but there's a lot of judgments and decisions to be made, and document them, please. We're still on the lease term, and when you are assessing the lease term, it's all about what period is enforceable. This is coming now to your question in the back. So sometimes only the lessee has an option to terminate. Sometimes both lessee and lessor have options to terminate, and sometimes it's only the lessor that has an option to terminate. Depending on which one you're in, there are different, the enforceable period could be different. So if we start with the first one, where only the lessee has an option to terminate a lease, well, at the end of the day, it's going to be, the assessment is all about the duration of the lease that the lessee is going to choose. Okay? And in making that assessment, the lessee will have to assess the likelihood of exercising or failing to exercise an option. And there's various things you could take into account. For example, the importance or the significance of any leasehold improvements that the lessee has made to the underlying assets. That would be something to consider in deciding whether or not I'm going to exercise a termination option. What about costs to terminate the lease? Termination penalties, the costs of installing and setting up a new asset, they could be quite significant. Perhaps the importance of the underlying asset to your business. If it's in a prime geographic location, you might not want to terminate. So these are things the lessee are going to have to make judgment calls about in assessing the likelihood of whether or not they're going to exercise a termination option. If both the lessee and the lessor have termination options, then you have to refer to paragraph B34, which reads as follows. A lease is no longer enforceable when both the lessee and lessor each has the right to terminate the lease without permission from the other party and with no more than an insignificant penalty. It's quite a mouthful. That word penalty is broader than just the contractual penalties that are stipulated in a contract. It would also include other economic penalties that are not explicitly stated. For example, a lessee. You know, how hard is it to go find a replacement asset, especially if that asset is very specialized? From a lessor's perspective, how hard is it to find a replacement tenant? Perhaps especially if it's out in a remote location. So these, just something to consider about when it comes to that word penalty. It does extend beyond just contractual penalties. We are going to look at two examples after this to try and demonstrate these principles. Where only the lessor has a right to terminate, you ignore that from the lessee's perspective, you ignore that termination right, because at the end of the day, the lessee has an unconditional obligation to continue paying for the right of use asset unless and until the lessor decides to terminate. So the lessee just assumes the lessor is going to enforce for the full period of the lease. And that's what I mean, you ignore lessor-only termination options. So let's quickly have a look at an example. Might just put things in perspective. CTL enters into a 5-year lease with locomotive machinery, or LNL, for a machine that will form part of CTL's production process. The cost to install the machine in CTL's manufacturing facility is insignificant. And CTL and LML each have the right to terminate the lease without a penalty on each anniversary of the lease commencement date. So the analysis is that the lease term is the 1-year non-cancelable period, because both lessee and lessor each have a substantive right to terminate without permission from each other, and there's no penalty. Cost to install is insignificant. So in that case, it's 1 year. You can then utilize the short-term lease exemption, and it will not be brought on balance sheet. Okay, so that's where both lessee and lessor have termination options. Next little example is where a lessee enters into a contract to lease a warehouse for 8 years. The lessor has the option to terminate after 5 years. As I mentioned, in this kind of scenario, you would ignore the lessor termination option, and the lease period would be the 8 years, because the lessor could enforce for the full 8 years. Okay, we cannot, as lessees, be expected to make a judgment about a lessor's intent and economic conditions. Okay. Right, so that is lease term, judgment. Once you know you have a lease, you know the lease term, the next question is, what do I include in calculating my lease liability? Standard is very specific. On the left-hand side, what do we include? Fixed payments. If I have a 5-year lease term, they escalate at 3% per annum. From commencement date, you know what those fixed payments are, you include them. You also include variable payments that depend on an index or a rate. So for example, if a lease's annual escalation is linked to CPI, that would fall into that category. Market rent reviews are also, that fall into that bucket. What I do want to point out is when you are busy doing this calculation, you are not expected to estimate what those CPI changes are going to be in future. Okay? You assume a constant rate, you use the rate, you use the lease payment as a commencement, and you assume a constant rate until such time as the rate changes, CPI changes, and your payment changes. And at that point, you update the remaining lease payments and you remeasure your liability at that point. Does that make sense?
No, but that's different to what you do for like long service leave. You're supposed to be estimating your discount rates and so on. So why do one thing over here, one over here?
I think it would just bring so much volatility
But it's
into your...
inconsistent. It's contrary to the principles-based approach we're supposed to have. You're going down this American bullshit of 1 + 1 = 3. We should be consistent. If you're going to do it for long service leave, do it for your leases. Or you don't do it for long service leave and other such liabilities.
I guess arguably the factors that you put in for long service leave is your future pay rises, and you have some sort of control over that. You don't have any control over CPI. Is the only argument I can say.
How would you know what those changes are going to be? You'd be remeasuring that constantly. So not only your balance sheet would now be...
Well, the banks will do it. They will have economists who work out. There's plenty of places. Where do you get your discount rates from? Then there's tables of people who are paid to do it. And then when you do the adjustment, what do you book as a prior period adjustment?
No, we'll get to that.
No,
It's all prospective, yeah. And it goes against right of use assets, so there's no impact to P&L.
Just Mickey Mouse accounting.
Yeah. Point noted.
Principal space should be the same for everything, same principle.
Yeah. It's a fair comment. But that's the rule under AASB 16, unfortunately. It would be hard work to keep on trying to estimate what your market rent reviews are going to do, what CPI is going to do. Yeah. Okay. If there's an option to purchase the assets and you're reasonably certain you're going to exercise it, you include that exercise price. If the lease term that you've assessed is on the basis that you are going to exercise a termination option and there's a resultant termination penalty, you need to include it. And then any amounts expected under RVGs or residual value guarantees, you include those. On the other side, you exclude variable lease payments that are linked to sales or use. So for example, rental of a leased a retail space, liability, and by extension your right of use asset. Hopefully it's not significant, but yes. And that is done by class of asset. Not lease, by class of asset. Okay, so just watch out for these I've seen a couple of lease agreements where it's clear as day, they are clearly separated. I've also seen one where it's a single charge and you don't know how that single charge is made up. Okay. I think based on this new standard, I'm hoping there would be more engagement between lessees and lessors in the negotiation phase. Lessees, you've got to ask the right questions. Perhaps I'm being naive thinking that they're going to give up the information. Okay, so now you know what your lease payments are. The next question is, at what discount rate do I use to present value those future lease payments to work out my lease liability? Probably one of the most challenging aspects under AASB 16 for you guys. So what is the discount rate? The standard says it is the interest rate implicit in the lease, if readily determinable. If not readily determinable, then you can use the lessee's incremental borrowing rate. So this is not a choice. You're supposed to use that first. Conceptually, the two rates are quite different. The implied rate is really specific to the lessor. And really, it's the lessor's minimum return on lease. Whereas the incremental borrowing rate is specific to the lessee. And that's the amount, that's the rate at which the lessee could borrow a similar amount for a similar period of time for an asset with similar security. Conceptually different. Now, as lessees, I don't think it's going to be very easy. In fact, I think it's going to be very difficult for you to go and calculate the implied rate. Because a lot of those inputs into working that out are specific to the lessor. And they might not give you that information. You might not have that information. So I think we are going to be pushed into using the lessee's incremental borrowing rates. I have been asked what is readily determinable. It's not defined in the standard, as usual. It's a judgment area, but I would think the harder you have to work to go and calculate that discount rate, that's not readily determinable. If you're having to engage experts, or if you are having to make a lot of estimates in working out the implied rate, I don't think that's readily determinable. So you'll be into IBR. Now, unfortunately, I cannot stand here today and tell you what your discount rate should be. I've been asked that a number of times. I don't know. But I can tell you what it shouldn't be, and that's your weighted average cost of capital. Weighted average cost of capital incorporates equity-based capital. It's unsecured, ranks behind other creditors, so it's generally more expensive than debt. You cannot use your your WACC. You also can't use, if you've got direct borrowings with the bank, you can't use that necessarily. Why? So while that rate will reflect your credit risk, it won't be specific to the amount, the lease term, the quality, or the nature of the underlying security. So that could be a place to start. And then you would just have to go make quantitative adjustments up or down to factor in these specific things to be compliant with AASB 16. It screams judgment. Okay. I think my message to you today is do not underestimate the time it will take to define your approach in this area. And document your judgments and your considerations for audit committees, for auditors, and even for regulators if they come knocking on your door.
So what you're effectively saying is you have to actually find what a lender actually lends you an unsecured loan because they've got no rights to security.
No.
It's on that asset though. You've got no actual asset for the...
Correct. Yes. What would they... But if it was a property lease, that property would serve as security. What would you...
It's not your property. So you
well, that's the challenge.
Find a bank that will give you an unsecured loan. That's the rate. That actually could be as high as WACC, could be even higher.
Potentially.
For the purpose of this, you would assume that you were buying. So the intention of using the incremental borrowing rate is to say if you weren't leasing, you were buying. If you don't have the cash to buy it, you've got to go to the bank to borrow the money to buy the asset. And therefore, what would the bank lend it? Technically, as the secured asset, it is. It is. So it's looking like you would have security because let's pretend instead of leasing, you bought it. It's a whole let's pretend game.
If you're leasing, if you own a property,
yeah,
that's got a life.
Absolutely.
Let's call it 100 years.
Agree.
Whereas you're talking about a lease term, what could be 5 years.
Yeah.
That's a totally different asset.
Yeah. 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 And that's why the challenge is in this. It is incredibly difficult to be able to, in an ideal world, you know, we have implicit interest rates in finance leases. We don't have them yet in operating leases. I would love to think they will start appearing, but as of yet they haven't.
And you know that's fine if you do have direct borrowings with a bank. There's some think about not-for-profit entities where they don't have debt. What are they going to? What is their incremental borrowing rate? There's been suggestion they're just going to pick up the bank and they're going to pick up the phone and ask the bank, what rate would you charge me for this asset for this amount for this period of time? I'm not sure banks are going to be dishing out hypothetical rates, especially when they don't even have a relationship with the customer. So this is probably what I've been asked on the most to date. I do not have answers. I would encourage you to, if you work it out, engage with your auditors early, and get your auditors to say that that's reasonable. Don't leave it to the last minute during crunch time during the audit.
Just a question.
Yes.
Wouldn't it be the same security that you give for the lease? So the security wouldn't necessarily be the billing, but it would be whatever security you provide to the lessor would be the equivalent security for a new loan. So effectively, it could be an unsecured loan against the business as opposed to secured against the property.
I would have thought it's the property, but I'm not 100% sure. Carmen, do you have any views? I would have thought it's the actual underlying asset, as though you're going to go and buy the assets. I think there's going to be a lot of it's going to develop and we're going to see, I did have a quick look at the types of discount rates being used, you know, if there was financials being, half-year financials being published just after June or in July, they varying. There was no kind of consistent theme. Carmen, I don't know if you've seen a similar thing.
I've seen them ranging from 2.5% to 14%.
Yeah, I was going to say about 11. That's what I saw. So this is going to be interesting times. Some of them were a lot lower than what I expected.
I know that we discussing the discounted rate. There's another part, the interest expense, which is going to come and when we're going to recognize the liability on the balance sheet and we're going to put that expense in
Yes.
the P&L side. So which rate we can use for that one?
So we'll get there in a second. Can I park that for now?
Okay.
Yeah. Yeah, so discount rate, sorry, I don't have many answers for you. Just start thinking about it. There is quite a bit of literature out there. I've read a few things, but it doesn't give much in terms of numbers. There's guidance, how to work out your credit spread and that kind of thing. It's quite technical. But yeah.
So we have to keep in mind materiality, like
absolutely.
It could be a situation if you use 2 or 5, it doesn't make much difference.
Do a sensitivity analysis.
You know, and
it's
you
a
just
different.
move on, right?
Absolutely. Materiality will always prevail. Yep. Good point. Thank you. So let's just quickly. Okay. So now we've worked out our lease liability. We start with our lease liability because that is your starting point for the right of use asset. It's the value that you've calculated for the lease liability, plus any initial direct costs, so the costs that you would not have incurred had the lease not been entered into. Costs of removal and restoring, that is your make good provision. Nothing has changed in terms of how you assess your make good provision under AASB 137. You still recognize a provision, a separate provision to your lease liability. The only change is now that the debit entry of that, if it relates to restoring the leased asset, the debit goes against the right of use asset. Also, payments made, any prepayments made before commencement date, that wouldn't be in your lease liability, obviously, but that is what that asset has cost you, so you need to add it. And then you deduct lease incentives received. So it's a pretty straightforward formula for your right of use assets. In terms of subsequent measurement, I see quite a few scribbling notes. We will be, are we distributing the slides afterwards? Okay, excellent. You will be all getting the slides. Yep. In terms of subsequent measurement, your lease liability is going to be increasing with your with interest. All right. It will reduce with your lease payments. It would be remeasured for changes in your lease term, changes in your estimated residual value guarantees, and changes in index or rate affecting payments. So in other words, your lease liability is going to be constantly remeasured under the new standard. When your liability is remeasured, the other side of your entry is the right of use asset. So there's no impact to P&L every time you're remeasuring your lease liability. And all these adjustments are prospective. You don't change what's done in the past, it's a change in estimates. I do want to point out one thing. I've been asked, okay, so which discount rates do you use? Do you use the original discount rate or do you have to change your discount rates? When it's a change in lease term, the thinking is the economics of the lease has changed. You would reassess your discount rate on date of reassessment and use that going forward for the remainder of the term. For these two, changes in estimated residual value guarantee and changes in index or rates, you use the original discount rate. Okay. In terms of the right of use assets, you've got options. What I see most of the time is cost model under 116. You also have revaluation model under 116 or 140 investment property. I would challenge you. You know, I know a number of clients manage their leases through Excel or accounts payable. With this constant remeasuring of your lease liability, is Excel is Excel going to cut it? The thinking is if you've got kind of less than 10 leases, you'll be all right. Anything more than 10 leases, you perhaps should be looking to a software solution. Some things like Lease Info or Lease Eagle, they are very similarly priced to help manage your leases under the new standard.
So what is the interest in the lease liability? The lease liability just being the expected payments discount? Like, why are we building an interest in?
So you've got a liability on your books. I guess that would, your effective interest rates, just got to think about this.
I suppose when you take your minimum lease repayments up, you discount it using the discount rate, and then as you make repayments, you recognise an interest expense to bring your liability back up to what it needs to be to extinguish it at the end of the lease term. So it's just the metrics because of the discount rate.
Happy? Sure, I will be around afterwards, just in the interest of time. So right in the beginning, I mentioned that you do have 2 optional recognition exemptions. So if it's a short-term lease or if it's a lease of low value, you've got these options available to you. You don't have to bring these leases on balance sheets. So short-term leases, anything less than 12 months, just take note, if there is an option, if your lease agreement contains an option to purchase that asset, it cannot be a short-term lease, irrespective of the probability that that option is going to be exercised. Okay. And this is an accounting policy choice, and that's by class of underlying assets. So if you treat one particular asset, if you apply this exemption to one particular asset in a class, it's got to be the entire class. Low value assets, that's the value of the asset when new. Basis for conclusion talks about US dollars 5,000. I've seen in practice 8 to 10,000 Aussie dollars. That's what people are classifying as low value. Okay, again, it's an accounting policy that you will have to put together and apply consistently to all your lease, and that's on a lease by lease basis. So from a practical point of view, are you going to make use of these exemptions? I encourage you to. Just take note that even if you do use these optional exemptions, still track these payments in your general ledger because you need it for disclosure. Okay. Turning to transition, if you look at the standard, initially it looks like there's 2 transition options, but there's 2 modified retrospective approaches. I've labeled them number 1 and number 2 just for ease of reference. I'm going to start with full retrospective. This is the hard one. Under the full retrospective, you are applying AASB 16 as though it's always applied. You're going to restate comparative numbers. There will be an adjustment to opening retained earnings on the first day of your earliest period presented. So for June year end, it would be 1 July 2018. You need a lot of historical data to be able to do this approach. The upside is you maintain your comparability in your financial statements. The other downside is that there's only one practical expedient given by the standard to help make this easier for you. So this is really the hard yards. I would think if you haven't started your implementation project yet and you have a significant number of leases, I wouldn't be recommending that approach. Under modified approach number 1, this is the easiest. It requires the least amount of, there's no historical data needed at all. It is a forward-looking transition option. What you do is, on date of initial application, which is 1 July 2019 for June year ends, or 1 Jan 2019 for December year ends, on date of initial application, you are only concerned about the remaining lease payments on those leases. You calculate your present value of your lease liability based on those remaining future lease payments using your incremental borrowing rate on date of initial application. So there's no looking back. Then what you do is, once you've worked out your present value of your lease liability, you make your right of use asset just equal your lease liability. No impact to opening retained earnings on date of initial application. The downside of this is that there is no comparability, or you lose comparability in your financial statements because prior years under 117, current years under 16. There are, however, additional disclosures that you have to make to compensate for that fact. Okay, so that is the easiest. Modified approach number 2, you calculate the present value of your lease liability exactly the same as you do for number 1, using your IBR as a date of initial application, except the right of use asset you go and calculate it retrospectively as though 16 had always applied, but again using incremental borrowing rates at date of initial application. That differential between your lease liability and your right of use asset will go to opening retained earnings on date of initial application, which is 1 July 2019. So this one is not as easy as this one, but it's certainly not as difficult as full retrospective. I have been asked the question, what happens to any lease accrual that you have on your balance sheet at date of transition? If you recall, under 117, we straight-lined our lease payments, and any difference between physical cash payments and that straight-lined amount would land up generally as a lease accrual on your balance sheet. So on transition to the new standard, Carmen might disagree. If under the first approach, where you're making the right of use asset equal the lease liability, you could set that lease accrual under the old standard off against the right of use asset. Or you could take it to opening retained earnings on date of initial application. There's two schools of thought. Under this approach, where you are calculating the right of use asset as though a AASB 16 has always applied, that lease accrual would go to opening retained earnings on date of initial application. So just something else that popped up in my head. So this is just a bit of a heat map to show you the different transition options. Clearly, the middle one, number 1, is the easier option because of all the green. Bearing in mind, you lose your comparability. So as an organization, you will have to decide what is more important to me. Is comparability important to me, or is reducing my cost and effort as much as possible important to me? Unfortunately, it's going to be a trade-off between the two. Okay, something else to consider. Let's quickly talk about practical expedience. What is a practical expedient? Practical expedients are special rules under the standard that make it easier to transition to a new standard. Okay. This one, the first one, which is about grandfathering previous lease assessments, is the only practical expedience available to you under full retrospective. Okay, this is the only one available, but you can also use this for modified retrospective. This allows you to grandfather any previous assessments that you've made applying AASB 117 and Interpretation 4. So you don't need to go back and reassess your decisions made in terms of whether or not leases are leases. Okay. Only new contracts on or after date of initial application, which is 1 July 2019 for June year-ends, only then would you start applying the new definition of lease under AASB 16.
Can I just add something there, Michelle? Before
Yes.
you all get excited and go, fantastic, we can ignore all of our old agreements.
Grandfathering.
Michelle said where you have previously assessed them under the old standards. If you have never even considered that certain agreements could be leases and therefore have never made an assessment under 117 and 4, this grandfathering does not exist for you.
You also cannot grandfather errors. If your assessment was wrong, blatantly wrong, you can't grandfather that incorrect assessment either. Thanks. I do encourage you, so this is an accounting policy choice that is applied to all leases or no leases. It's not on a cherry picking basis. I encourage you to make use of this It's probably one of the first decisions you need to make because it essentially sets the scope of your work to be done under the implementation project. It will reduce your work. Okay, so use that. Any practical expedients that you make use of, you need to disclose. And then if you apply modified retrospectives, you have a couple of, you've got an extra 5 practical expedients that you can use to make your life easier. So you can apply a single discount rate to a portfolio of leases with reasonably similar characteristics, such as similar remaining lease terms, similar class of underlying assets. You can also, if you've got onerous lease provisions under 137, you can rely on those, and on date of initial application, you just set them off against your right of use assets, and that will approximate impairment. So you can rely on those provisions you've previously made. Where any leases end within 12 months from date of initial application, you're going to treat it as a short-term lease. Expense on a straight line basis. Okay? Where you are applying modified number 2, so you're calculating the right of use assets as though as though 16 is always applied, you can ignore initial direct costs. They might not be significant, might not be a big deal, but that practical expedient is there. And practical expedient number 6 allows you to use hindsight, especially when it comes to options to extend and terminate. You know, hindsight is the perfect side. You know what you did, so it allows you, you're allowed to use hindsight. So, as an organisation, are you going to make use of these practical expedients? Note that you can use these interdependently. These can be applied on a lease-by-lease basis. You just have to disclose which practical expedients you're using on transition. Okay. Just some other considerations. This standard is going to redefine key performance indicators. EBITDA is going to be redefined. It's going to improve because the change in your expense profile. Things like net current assets, net debt and gearing, interest rate cover. And then you've got to ask yourself, all right, if these are being redefined, how does that affect my debt covenants? Now, very often debt covenants are based on frozen GAAP. Don't assume that. Your ability to declare dividends, because on transition, there's potentially an impact to opening retained earnings, and also the change in your expense profile and the impact on P&L going forward. Does that impact your ability to declare dividends? I cannot encourage you enough to take your stakeholders on your AASB 16 journey. They will want to understand the transition option that's being elected. They will want to know the cost of this implementation project. They will want to know how our business processes and systems are going to have to change to deal with this new standard and the continual remeasurements. Take them on your journey. They don't want nasty surprises right at the end, especially with transition. They're going to want to know the impact. And then Shane, the kid that's always left at the bus stop, disclosures. There are new disclosures. It is a new standard. We are not familiar with them. Make sure you are across them, and don't leave it to the last minute. Come audit time. I want to just end off, Carmen is smiling. I just want to end off 2 minutes on a change to the income taxes standard. Now, under AASB 16, this gives accounting for an operating lease under AASB 16 gives rise to an asset and a liability, right? Now, tax deductions, and I'm not a tax person, I should have actually started this slide. I'm not a tax person, I'm an accounting person. So Joel, correct me if I'm wrong, but tax deductions can relate to either the right of use asset or the lease liability. So if it's the lease asset, it would be depreciation and interest. If it's the lease liability, it's the repayment of that lease. Now here in Australia, the ATO would give us, we get the tax deduction when we pay the operating lease payment. Okay, so just keep that in mind. Now, depending on whether or not you allocate those available tax deductions to the lease asset or the lease liability, a temporary difference could arise. And to date, there has been diversity in whether or not the initial recognition exemption applies to that temporary difference. Some entities apply it, so they don't account for deferred tax. Some entities do apply the don't apply the initial recognition exemption, and they are accounting for deferred tax on leasing transactions, which makes sense, because although you have a right of use asset and a lease liability, there's only a single tax treatment related to both. So in my view, there should always be deferred tax. Anyway, this diversity in practice and the advent of AASB 16 has prompted the International Board to make a narrow scope amendment to the income taxes standard, which is going to limit the application of the initial recognition exemption. In other words, here in Australia, there will be deferred tax arising on right of use assets and lease liabilities. So that's the message. The change is not in yet, but it no doubt will go through. So we can take guidance from that in accounting for our deferred tax on leases now. So just something to be aware of. Okay. If this was too quick or you want to deep dive into the detail, HLB does have a leases series on our website that really goes into detail on all the aspects we've covered today. So it is there for your use.
So we've heard tax, we've heard leases. I'm going completely different. I'm going about who actually needs to comply with all of these standards and the changes that we are making to general purpose, special purpose financial statements. What I'm talking about is the biggest change that AASB has put through for a significant number of years. We've been working on it for a number of years. We've been out there reaching stakeholders to try and make sure that this wasn't a surprise to most people, but it's really important to understand what's happening. So obviously, I'm from the UK, you've got two international presenters today. When I moved out here 19 years ago, we had this concept of the reporting entity, and I said, what does that mean? What are these weird special purpose financial statements? And I was told that you're a reporting entity if it's reasonable to expect the existence of users. And what does that mean? I've got a maths degree, I'm very much a black and white type of person. Reasonable to expect the existence of users, huge amount of judgment. And I've had numerous discussions with audit partners, I've had numerous discussions with CFOs to try and say, well, why are you producing these weird special purpose accounts? And they said, well, we haven't got any users. Well, how do you know? You provide them to the bank, you lodge on the ASIC website. Do you actually know who's accessing your accounts? So as a board, we've been working really hard with ASIC to try and understand how many people are accessing financial statements. And it's quite phenomenal. As much as you have to pay for them, the number of financial statements that are purchased is actually quite significant. If you prepare your financial statements and give them if you submit a tender, well, that's somebody else who's a user. There's always throwing out there about employees, creditors, trade unions, etc. So what we decided we want to do as a board is make it much clearer. If you are this, then you do this. To remove the judgment, to give us the consistency so everybody understands. And that's where we are with this particular project. It gets bigger. The more that we look at it, the more we realise that there's extra components to it. So what I want to do is bring it back to where we are today and also ask you for help at the end of the session. So I thought it would be useful to see how am I impacted. Depending on which entity you are, depends on what the impact is going to be. Now the first impact, the biggest impact is going to be in that first box. If you are a large proprietary company, and that is a large proprietary company under the new thresholds. Remember we talked earlier in the year, those thresholds have now been doubled. If you continue to be a large proprietary, because of the wording in the explanatory memorandum that the Department of Treasury put out, they said we are doubling it, all entities who are still large are economically significant in Australia. There is no way you can argue it is not reasonable to expect the existence of users. Therefore, from 30 June 2020, large proprietary companies should be lodging general purpose financial statements. So we're in that financial year now. 30 June 2020 is not that far away. If you are not currently complying with recognition and measurement, that's an issue for you. You need to start looking at, you need to start thinking about. Now we're aware of the deadline, so what I'm talking about in the new standards we're issuing, we have committed to issuing them by 30 June 2020, so we will actually give you a framework to be using. So that's the biggest issue, is large proprietary companies.
Then we split it up into other for-profit entities. So we've split the for-profits and the not-for-profits because we said they're different. They're very different beasts. If you look at who should be reportable in the not-for-profit space, the thresholds are much lower. They get the great benefit of tax deductibility on donations and things. And that's something as taxpayers we're all funding. So therefore the accountability is much lower. But you've got very different entities in that space. So we said we need to give both types of entities justice, we need to separate the project. And we thought that the for-profits were a bigger priority for us. Let's get those sorted, and then the not-for-profits, we can work on that. So the proposal that we currently have out on exposure draft is for other for-profit entities that are not large proprietary. So we're focused on for-profits who are currently producing special purpose accounts. From 30 June 2020, if you meet certain criteria, and I'll talk about those on the next slide, you are producing general purpose accounts. There's no judgment, there's no is it reasonable to expect the existence of users. In the not-for-profit space, if you are currently preparing general purpose RDR accounts, which we know there is a lot of not-for-profits in that space who are, we're actually getting rid of RDR. Now, before anybody panics and everybody suddenly looked up and went, what? We are actually introducing a new reduced disclosure type regime, and I will talk about that. It will make your life easier. So you can still keep doing RDR, there's some extra disclosures you need to add, or you can just adopt this new approach. But we're not maintaining a set of reduced disclosure financials anymore, and I'll give you the rationale behind that. From 30 June 2020, not-for-profits who are preparing special purpose financial statements will have an extra disclosure, and I will cover that a little bit later. And watch this space for the other changes, and I'll give you an indication of where we're currently thinking. So I wanted to include this just so you can sit and think, where am I and what slides do I need to particularly pay attention to? So our proposal for for-profit entities is that you are preparing general purpose financial statements if you meet one of these two criteria. The first is that you are required by legislation, that could be federal legislation, it could be state legislation, it could be any other legislation, to prepare financial statements that are in accordance with accounting standards or Australian accounting standards. So it's very clear that you have to comply with accounting standards. So that's where our Corporations Act is included. It's any other for-profit legislation. Or you are a for-profit entity that is required by some other document to comply with Australian accounting standards. So we've dropped the accounting standards bit for these guys because we want people just throw that in. Whereas if you're actually referring to a framework under the Australian accounting standards, that's general purpose. Now that could be things like a trust deed. It could be a bank agreement. It could be some other constituting document that requires financial statements in accordance with Australian accounting standards. What we've done, however, is we've put a grandfathering provision in there. We've said if you're currently operating, and let's use a trust, if you're currently operating under a trust deed that requires compliance with Australian accounting standards. Well, these rules didn't exist prior to 1st of July 2020. So we're not going to make you go back and say now general purpose. What we've said is if that document was either issued or amended after the 1st of July 2020, when this is effective, somebody has made the decision that they want general purpose accounts. So if you don't want general purpose accounts, take those words out. If you are amending the trust deed for any other reason, you need to also take out those words about Australian accounting standards if that's not what is meant. So if your current document refers to Australian accounting standards, that's okay. If it is changed after 1st of July 2020, you are captured. So it is something to be very strongly aware of, those of you who are not operating in the corporate space. Any questions on that? So that's only our for-profits at this point in time. So I actually stole some of the slides from the Accounting Standards Board because they wrote it and I just stole them. They introduced this decision tree in one of the presentations they've just done, and this full presentation that the staff did is on their website. And it's just a good way of capturing who's in the scope of this particular phase 1 of the project. So the first thing is, are you a for-profit private sector entity? If you answer no to that, you're out. What I'm talking about is not relevant to you. I'm not going to talk through each of these because you can read it just as well as I can. But
it gives you a bit of a decision tree. Follow it through so you know exactly what your implication is. It's just a different way of illustrating what I've been talking about. Bringing back to specific entities, just so you can understand. So who is in companies lodging under the Corps Act? Legislative requirements, constitution or other document, as I said, that's amended after that date. Or if you are a for-profit who elects to comply with the revised conceptual framework. So remember, I've talked in previous sessions about the conceptual framework internationally has changed. That introduced a concept of reporting entity, conflicted with our definition, and that was one of the motivators behind this. So if you are currently choosing to comply with the revised conceptual framework, you're giving an IFRS compliance statement, or you want to do that, you are captured by this. Not-for-profits, public sector entities are out. Legislative requirements where you only have to provide financial information. So give us an acquittal, or give us just a summary balance sheet, a summary P&L. We're talking about a proper financial report, proper financial statements, or the document was issued before 1st of July. So those last 3 slides say very similar things. They're just shown in slightly different ways, so you can see who we're meaning to be captured by this. So if we're doing general purpose accounts, what does that actually mean? We will still have Tier 1, which is our full IFRS, which is what the listeds have to do. That will never change. That is what we need to give a full IFRS compliance statement. So all recognition and measurement, consolidation and equity accounting, all presentation and relevant disclosure. Our proposal for Tier 2, as I said, we are getting rid of reduced disclosure. We will no longer be retaining the grey shaded in each of the standards. What we are proposing is Tier 2, the working name is called Simplified Disclosure Requirements. I hate the name, but nobody can think of a better name. So SDR, which will still be all recognition and measurement. The numbers will be identical. So general purpose accounts, numbers in full compliance with the accounting standards. We will clarify that consolidation and equity accounting has to be complied with. So no longer can you do a set of accounts and say we're choosing not to comply with the consolidation standard. And to be honest, that's the thing we think will be probably the hardest work for a lot of entities. Because a lot of entities, if you say to them, why are you doing special purpose? And you actually get to the nub of why they're doing special purpose, it's because they don't want to consolidate. Under this, they have to. There is no choice. There is no, let's use the ASIC regulatory guide that kind of might indicate that consolidation is not required. It is mandatory. Most presentation requirements, we have eliminated the need for the third balance sheet, same as RDR does not have that. And all of the disclosures are now going to be in one accounting standard. Now I do a number of model accounts, I do a number of disclosure checklists. I can hand on heart say when you try and do a disclosure checklist for the RDR standards, it is horrific. Because you've got to go through every single standard, you've got to work out which bits are shaded and how it all flows through. All disclosures will now be in one standard, and that standard is based on IFRS for SME. Most of you have probably never even picked up IFRS for SME. It is actually a plain English accounting standard. So we've taken all of that wording from IFRS for SME, and that's effectively your disclosure checklist. This is the only thing you have to comply with. For disclosure purposes, you do not have to go into any other accounting standard. You still need to go in there for recognition and measurement, but not for disclosure. So we've made the disclosures lower because we're starting at IFRS for SME, whereas under RDR we started at full IFRS and dropped them. So there are a lot less disclosures, and it's worded so much nicer, and it's all in one standard. So that's what our Tier 2 will look like. Now for the not-for-profits in the room who are currently preparing RDR, I'd encourage you to move on to this, because you are in a framework that is no longer going to be supported, because we think your life will be much easier in this, and we think it will be more meaningful. We still get lots of comments about there's lots of stuff in RDR that we think you can take out. Well, hopefully we don't get as many of those comments under here. So if we look at just some changes between SDR and RDR, these are areas where there is much lower disclosure in the simplified disclosure than in RDR. So things like the revenue disclosures. Any of you in the for-profit space who have spent time trying to work through the revenue disclosures, there's not a lot of reductions under RDR. There is significant reductions under this. The leasing standard, we reduced the disclosures. The financial instruments, we've reduced them further. Business combinations, interest in subsidiaries, etc., we've reduced them. There is a proposal of an option not to prepare a statement of changes in equity. Now, traditionally, we say that you always have to do 4 primary statements. That